The purpose of this FLAR dialogue is to analyze how capital flows to Latin America have been affected by global economic conditions as well as local economic conditions. We shall also analyze and discuss the perspectives, risks, and opportunities that the region's economies have in this scenario. This region is highly reliant on foreign financing, which is critical to macroeconomic stability and sustained growth. We are pleased to have some keynote speakers in the region who come from the academia, the private sector, and some of them who held public positions in government. So this is a great opportunity to talk about the different insights on issues that are very important, such as the perspectives concerning capital flows in the current scenario that is characterized by high interest rates and some signs of geopolitical fragmentation. We extend our appreciation to Maria Paola Figueroa, who is the head of Frontier LATAM Research at Institute of International Finance. Pablo Guidotti, who is the dean of the School of Governance and a professor of economics at Universidad Torcuato Di Tella, and Martín Castellano, who is the head of Latin America Research at Institute of International Finance. So we shall do the following. Each speaker will do a presentation, as I mentioned before, and then we're going to have a closing Q&A session where you will have the possibility to make remarks or share your comments. So let us get started with Professor Pablo Guidotti, our first speaker today. He is a scholar. He was also former Vice Minister of Finance. He advised several private banks and multinationals, among other positions. Thank you very much, Mr. Guidotti, for joining us today. You have the floor. Thank you very much, Carlos, for inviting me to participate in this webinar. I'm delighted to be here today. This is what I'm going to do. I'm going to walk you through the global landscape concerning capital flows, interest rates, and we shall also discuss what we could expect going forward. The outlook, let's say. Of course, the timing of this webinar couldn't be any better. Tomorrow, the Federal Open Market Committee of the Fed will be announcing a reduction of its monetary policy. So right now, there is a lot of uncertainty. We expect a 25 basis points reduction or a 50 basis points reduction in interest rates after this announcement. Therefore, I believe that we are currently at a turning point in the global economy, at least from the emerging markets perspective and from the standpoint of capital flows. So it's a good timing in order to quickly review what has transpired over the past 2 or 3 years, mainly because as the Fed chairman did in Jackson Hole, Mr. Powell, there are perhaps some aspects underlying inflation that is now coming to an end of this cycle that have not been addressed with as much focus as required. When listening to people giving their interpretation about what has happened, we should highlight two centerpieces. On the one hand, the disruptions that have affected the real economies or supply chains as a result of the COVID-19 crisis. And second, the response of fiscal policies across the globe, and particularly in the United States. In my opinion, however, scarce significance is being attributed to the monetary phenomenon. During the COVID-19, there was extraordinary liquidity expansion, far exceeding what we witnessed back during the financial crisis in 2008 and 2009. When analyzing the relationship between liquidity expansion and inflation, to some extent, during the 2008-2009 GFC, that liquidity expansion somehow substituted the destruction of liquid assets that happened as a result of such GFC. Therefore, net liquidity did not go up, and therefore there was no reaction by inflation in that context. Now, during the COVID-19 period, we witnessed an increase of precautionary money demand. Therefore, the expansion of central banks at the time somehow accompanied or accommodated that increase in demand. But as the COVID-19 crisis faded out and we went back to normal, I believe that central banks, and specifically the Federal Reserve, didn't realize that we were going to face a price leap, and the Fed's reaction was particularly slow at the beginning. With regard to an inflation rate hike. In Argentina, central banks used to a particular monetary policy, by contrast, was the first one to take action. So I'm not trying to undermine the importance of the supply-demand issue or fiscal policy. But I believe that capital flows are very important, especially in order to understand why is it that right now we're faced by a soft landing in the US economy. Whereas at first, people were thinking about a Phillips curve and thought that inflation was going to go down because we were in the phase of a downturn cycle. Right now, even though that we might expect an economic slowdown in the coming quarters, the U.S. economy is still growing at a relatively healthy level. What was the outcome that this had on capital flows into emerging markets and specifically Latin America? Based on the data provided by JP Morgan on a weekly basis, we can say that the truth is that since 2022 to date, we have witnessed the longest capital exits ever from EMs. And this was particularly marked in 2022 in the amount of 90 billion euros. That was the capital outflows. That went down to 34 billion in 2023. And according to this database, during 2024, on a net basis, and even though during some periods these capital outflows went down, we still continue to speak of 15 billion US dollars in capital outflows. Now, thanks to Martin Kindness, who gave me some data, I was able to analyze the reaction of the flows measured by JP Morgan and that are monitored by the market. And the yes, there is a very close correlation throughout recent history in this regard. However, I believe that in 2024, we might see a difference between both databases, and the IIF figures might be a little bit more positive compared to the ones shown by JP Morgan. However, this does not change the overall picture. Over the past 3 years, we have gone through very difficult times in terms of capital markets in the context of the emerging economies. Therefore, policy frameworks in emerging economies, and despite the fact that all authorities had to react to the COVID-19 crisis leading to increased indebtedness, I believe that today our policies are much stronger compared to the past, and no many defaults have occurred. The defaults that have taken place relate to Sri Lanka, Ghana, Zambia, and Ethiopia, which is going through a restructuring process. By contrast, in Latin America, we didn't experience significant setbacks, even though many countries remained isolated from the capital markets, and today they expect to be able to re-enter the capital markets. This has all run in parallel with other changes that have to do with financial assistance from the international community. New significant players have arisen, such as China or countries in the Gulf region that have posed significant challenges in terms of debt restructuring in the countries that I have just mentioned. And they are also now focusing on the role of the IMF in particular. They are zooming this in. So the review of the IMF's policy should perhaps be done in a context that is not that of a crisis, but of an economic rally, rather than so that we can improve institutional design. Going forward, international interest rates are now going downwards in the United States, for example. We might talk of an equilibrium rate in the United States between 1.5 and 2%. If we take a look at inflation right now in terms of PCE that takes into that is normally analyzed by the Fed, and if we analyze the measures that will arise from the Taylor rule, we see or we can expect the monetary policy rate to go down to 4.25 to 4.75, which is quite reasonable. And that is perhaps where the market is heading to. Going forward, therefore, we need to take a close look at the real rate in the United States. The actual interest rate in the United States right now stands at the same level as that prior to the GFC. Over the past months, it has come down significantly. There is one measure calculated by the Cleveland Fed. It has fell from 2.1 to 1.5. So over the past 10 years, we have observed a drop in the actual rate. Now, what do we expect going forward? It's quite interesting to take a look at the debt or borrowing market in the United States. The US Fed right now has $25 trillion. Its cost for the country has grown over the past 2 years from 1.6 to 2.8. So this has led to increased interest costs, which has been quite significant. On the other hand, other significant changes have taken place as to the holders' composition. If we take a look at the federal borrowing stock in the United States in 2007 prior to the GFC, and if we compare those data with the current date, It increased from 5 trillion to 25 trillion. That is to say, was five-folded. In 2017, most of the Treasury's debt were in the hands of international holders, more than 50%. Right now, we are talking about one-third. That is, the rest of the world has not been able to accompany increased borrowing as a result of the U.S. fiscal deficits that right now exceed 6% of GDP. Therefore, the debt burden in the United States right now is being borne by the global market. If we now take a look at external U.S. Treasuries holders back in 2007, more than 50% was held by Japan, China, and the United Kingdom. Japan accounted for 25% of debt held by foreign holders, and China 20%, and the UK 7%. Now, since then, major debt holders have reduced their holdings. Right now, Japan holds 14% by contrast to 25, China 9.6 rather than 20%, and the UK, however, has increased its holdings after the Brexit. However, the major two holders have reduced their holdings, and in the case of China, they have reduced their holdings to 400 million since 2021 in nominal terms, not only in terms of share. When we take a look at these numbers, I believe that unless fiscal policy in the United States changes dramatically, and unless it avoids the gross borrowing level to continue to grow, there will be an upward interest rate trend. Therefore, I do not expect a world of very low interest rates going forward unless we have a very sharp economic downturn. However, I don't think that that is one of the most plausible scenarios as we speak. If we take a look at the coming elections in the United States, and if we take a look at the U.S. candidates, even though it seems that there are no major differences as to their economic proposals, they're not recognizing fiscal deficit as a key issue. They mainly talk about tariffs, but they do not show much concern about the macroeconomic aspects. Therefore, this is an open-ended problem that will exert pressure on interest rates upwards in the future, and then will keep a relatively challenging scenario in place, even though we are going to be better off compared to the past 3 years. Let me close by saying that I'm rather optimistic because I believe that inflation has been beaten already, and we will begin to have lower international inflation rates going forward, which will reverse capital flows and will enable emerging economies to access capital markets. Of course, afterwards, there are some domestic issues to deal with. But apart from the geopolitical scenario, the US fiscal policy will continue to exert pressure for real interest rates not to go back to the levels that we were used to between the global financial crisis and the COVID-19 crisis. Therefore, it will pressure borrowing costs for emerging economies that will be relatively high. Okay, let me stop here and then I will be glad to answer any questions. Thank you very much, Pablo, for sharing your opinion about the determinant factors that affect capital inflows in the region, particularly those related to monetary policy, interest rates, inflation, and um, public debt and corporate debt as of late. You have emphasized how the U.S. economy has been experiencing a soft landing, fortunately, and how the monetary policy affected that process. So we should expect a reduction in nominal interest rates. But on the other hand, there is pressure due to high borrowing levels. And as a result, it's difficult to think about going back to rate levels prior to the ones that we had before the pandemic. This could also lead to sudden stops of capital flows in the region. However, this has not been materialized despite the fact that we have been going through a scenario of high interest rates over the past years. However, we have to be ready for that. As you have said, we are going to deal with that afterwards during the Q&A session. Now we're going to move on and we are going to hear the opinion of private sector's experts, Maria Paula and Martin, who have been analyzing Latin America for many years from the perspective of the central banks and the private sector. So Maria Paula, you have the floor. Martin, you have the floor as well. So please do share your view about the macroeconomic context in the region and our impact on capital flows. You have the floor, Maria Paula. Thank you very much, Carlos. Good afternoon, everybody. Thank you very much for joining us at this session today. It's very interesting for us to share with you our view about capital flows, taking into account that at the IIF, we keep a close look at highly frequent data that are showing quite an interesting performance in terms of strengths of capital inflows into emerging economies. So we are in Colombia. Right now, we are on an official visit. We will be talking to many colleagues and counterparties in Colombia. So thank you very much, Carlos, for allowing us to be here today. Could you please show the first slide? Okay, so let me start out with the global economic scenario according to the IIF. We have been discussing this in depth with Carlos Giraldo. We have been talking about current trends and trends going forward. We should highlight that geopolitical tensions have escalated. They are quite high right now, and they, of course, will have serious consequences for the global economy. We have also witnessed the conflict in the Middle East, also the long-standing war between Russia and Ukraine, and a significant deterioration in the relationship of democracies in the West and with regard to China. All this has led to a complex global scenario with heightened tensions. Against this volatile background, politics has become particularly important, including the US elections in November, which is going to be perhaps one of the most important global political events with a long range consequences for U.S. and international policies. These will also have consequences in terms of defense spending. Now, in the global scenario, we see this performance as a result of the performance of the most important economies, the United States and China. In the United States, we believe that monetary tightening as a result of measures by the Fed will lead to some acceleration of corporate spending, but that will also reduce spending by consumers. In China, we believe that the economy will speed up because the data that have been published show an acceleration of the Chinese economy. Therefore, we expect a 2.9% growth in 2024 and 3% in 2025, with a small slowdown of 3.1 compared to 2023. If we take into account the basic growth effects, or what we call real growth at IIF, this is graph number 2 on the right-hand side, you can see that there will be a very soft economic growth moderation, and we could expect a slight growth improvement across these economies. We believe that a 3% growth rate is quite similar to the global economy's performance prior to COVID-19. So we're going back to growth rates that are quite positive. Regarding the monetary policy, and based on Chairman Powell's speech in Jackson Hole, everybody watched that announcement live. Of course, it was quite obvious that they were going to start cutting interest rates as of September. We believe that there will be a 25 basis points interest rate cut, which is a little bit below the pricing announced by the market. In the market, people spoke of 50 basis points, but we believe that the interest rate cut will be of 25 basis points this year, with the monetary easing in 2025 and going forward. Regarding Europe, in Europe, we believe that there are many challenges. We believe that Europe will grow by 0.5%, similarly to 2023. As for interest rate cuts by the Fed, this will have a significant impact on the emerging economies that are highly sensitive to U.S. monetary policy changes. So there will be lower interest rates, and as a result, investors will try to seek greater returns in emerging economies, as it happened in the United States when interest rates were low. We believe that this might lead to a weaker dollar with some positive effects, because it might lead to a reduction in debt servicing, especially in the cases of economies that are highly indebted. And eventually, that will also reduce capital outflows as a result of this. And as Pablo said, there will be a reduction in abrupt capital outflows. So return spreads or differentials between emerging countries and other economies are more attractive, and we also expect a currency appreciation in emerging economies, lower spending, and of course, the support of the local bonds of fixed income markets. However, if we want to make sure that these effects or positive effects on emerging economies will be long-lasting, we see in the next slide the outlook for capital flows. Not all economies will benefit alike, and this will of course, depend on initial economic conditions and the policy response given by each country. In Asia, for example, Asian economies seem to have significant room in order to relax their monetary policies and therefore to catch up a little bit, because so far they have not eased their policies very much. In Latin America, as Pablo said, the situation is different. Latin America has been increasing interest rates lately, and as a result, it has been able to cut rates earlier. However, right now, there are many countries on hold, and this is due to the fact that some countries are a little bit worried about inflationary pressure. So these countries might not have the same amount of room in order to cut down on their interest rates. Afterwards, Martin will talk about the situation in Brazil, where we expect also a reduction in interest rates as of next week, to be announced by the central bank of the country. The geopolitical scenario will also play its part, and the risk sentiment at a global level. This will also determine how emerging economies can respond to the Fed's interest rate cuts. We hope that overall lower interest rates will increase risk appetite. However, geopolitical tensions, for example, in the Middle East, or if the relationships between the US and China worsen, global risks might pent up, and that might affect capital flows into emerging economies. Okay. Here you can see our capital flows indicators, and this is what we expect in emerging economies. Here you can see the driving engines that might boost capital flows. So as Pablo said, we observe improved capital flows towards emerging economies, despite the fact that we have observed some volatility and challenges as of late. However, over the past 2 years, there has been a thrust of capital flows towards emerging economies. This has happened this year and in recent months, according to some short-term indicators shown here. This is the result of a better outlook for the emerging economies in connection with developed economies that are characterized by higher growth and better interest rate spreads. As Pablo said, in the past, people were afraid about the Fed's decision about cutting down on rates, which might lead to an economic slowdown. But right now, we observe that we are experiencing a soft landing scenario, which is positive for capital flows to emerging economies. If we take a look at the geographical composition, Asia Pacific countries receive more capital inflows, accounting for 40% of all capital flows coming to these countries, followed by Latin America with a 23% share. As for capital flow projections, we see an increase this year and stability to come next year. Also, the FDI, which is a stable source of financing, and which can also contribute to financial stability in the different economies. Lastly, the IIF published a snapshot of capital flows as of August, which is very important to observe how recent volatility in the markets has affected the country's portfolios. In August, portfolio flows remained strong, particularly with regard to emerging economies, with a very positive takeaway. The graph shows in the next slide the flows tracker. These are the data released in July. Here you can see stocks and debt. So portfolio flows rose in June, and in August, the same happened. So capital flows during this period was similar to that reported in June. Despite the fact that there was some market volatility due to different developments, economic risk, and monetary policy uncertainty, in August, all the same, flows remained strong, flows going to the region. Now, the estimated Fed rate cuts have already been priced in by the investors and by the different economies, and therefore investors are not positioning themselves in order to enter the emerging economies and markets more strongly. If we now take a close look at China, as Pablo said before, China has been taken up significant capital inflows. Recently, there has been a slight slowdown, but in 2024, we expect an upsurge in capital flows going to China. Right now, there is a little bit of uncertainty due to the signs cast by the Chinese economy and due to some regulatory uncertainty in the country and due to domestic demand performance, particularly in the real estate market. Therefore, we are a little bit more cautious right now, and also due to the divergence in terms of monetary policy in the US and China. In China, this policy is becoming a little bit more flexible now, and therefore this might attract more assets. So we see that the Fed rate cuts might boost capital flows. So the performance of interest rates will be or will have a positive effect, particularly in countries with economic stability and with a good, favorable growth outlook going forward. I believe that we can move on to the next topic. I believe that I still have 5 more minutes. A couple of more minutes, just 2 minutes, Maria Paola. Okay, so please, next slide. As I mentioned before, geopolitical risks will somehow determine how the different economies will react to lower interest rates and how they can benefit themselves from such a development. As of late, we have observed what has happened in terms of monetary policy in the United States and China, which is affecting commercial trade. This could lead to lower trade and investment flows. Geopolitical tensions have, in fact, affected capital flows. This graph shows the evolution of global trade, which grew significantly with China being the leader and which has become the global trade leader. These countries were particularly resilient during the 2008 and 2009 global financial crisis, with a significant drop and upsurge. Afterwards, the same happened during the COVID-19 pandemic, where supply chains were significantly disrupted globally, but we have also observed a strong recovery after the pandemic. In 2008 and 2010, we have witnessed escalating geopolitical tensions, more restrictions, more barriers to trade, and different sanctions that have affected capital flows, leading to a slowdown in trade exchange. However, we would like to emphasize that this data show that global trade has rallied, which is quite positive for growth prospects this year and next year. And finally, let me introduce the following topic that is tied to the geopolitical arena. I'm referring to the role played by the United States in global financial markets. Despite challenges and greater influence by countries such as China, the United States remains the dominant country in global capital markets. So geopolitical tensions come with some significant implications for emerging economies. We have been therefore analyzing such implications, and we believe that such implications pose both opportunities and challenges. Next slide, please. Why do we say that the dollar remains the strongest currency? Well, the US institutions remain strong, the same as their financial system. So despite the fact that there are certain challenges, the reduction of interest rate spreads indicate that the dollar dominance remains stable in the global financial system, as I mentioned before. However, there is a differentiating factor across the different economies, and therefore I would like to hand over to Martin because he will talk specifically about Latin America. Thank you very much for your attention. Thank you very much, Paula. I would also like to thank Carlos and the FLAR's team for allowing me to participate at this webinar. In fact, I'm going to place Latin America in the spotlight right now, and I'm going to be quick so that we have time for answering questions. I believe that both Pablo and Maria Paula have given a very exact picture of the global aspects that are affecting the region. We have an optimistic view about capital inflows into the region in 2024. As Pablo said, we have observed that it has been a hard year in terms of flows with a great deal of volatility, but it has not been critical, as also Carlos pointed out. In 2025, I believe that we can continue being optimistic, but with some risks in the horizon. In the case of Latin America, we should say that the capacity to attract capital flows and the price of assets are affected by foreign factors. Today, we are talking about domestic issues such as fiscal policy, elections, social aspects. Of course, all these aspects are relevant. Lately, we have been to Brazil talking to some investors, and everybody was talking about the fiscal policy. However, we believe that there are external factors affecting capital inflows into the region, and these foreign factors particular in some countries that require financing, that do not have many dollars in their legal banking reserves. Other countries are a little bit more positioned. Chile is better positioned. Others are not that well positioned, such as Argentina. Some countries have some high financing requirements from the private sector in dollars, as well as high FDI flows. If we analyze FID flows over GDP in Chile, they are twice as much as in Mexico. Therefore, in the next slide, we see that some countries, such as Mexico, that has a great deal of potential for FDI, has a very broad export manufacturing base. Therefore, it's better positioned in order to benefit from shoring trends. Brazil is a much more closed economy in this respect compared to Mexico and Chile, but it's very diversified. Over the past 3 years, in Brazil, the main export commodity became soy, iron, and right now oil, and therefore this gives the country a significant buffer. The next table shows our macroeconomic projections for the region. Next slide, please. Taking into account growth prospects and current account prospects. In this case, I would like to highlight 5 aspects that are affecting capital inflows into the region. First off, the growth differential compared to developed countries. In the case of Latin America, the global economy this year, it's affecting it negatively because there is a slowdown. It remains high. However, in Latin America, growth has slowed down a little bit. If we set Argentina aside, we still see a slow down in other countries. Then there is a geopolitical aspect. I believe that on average, the region is benefiting as a result of the fact that it's far away from the areas where major world conflicts are taking place. In the past, the fact of being so far away from the world was a downside. Now it's an upside. The same happens where dependence or reliance on commodities or green energy has favored the region. Right now, that we see commodity prices plummeting. The current account deficit remains balanced because there has been a positive effect on the import side that has somehow softened the impact. Even in more complicated geopolitical contexts in the Middle East, for example, this will push commodity prices up, but prices in the region, by contrast, will remain relatively resilient. Talking about geopolitics, there are 2 factors that support capital inflows: reformulation and the repositioning of production chains, as described by Pablo, as well as portfolio rebalancing in order to invest in emerging countries. In the case of value chains, I believe that Mexico and Central America will continue to be favored. We might see some fragmentation and some infrastructure bottlenecks that will buffer the impact, but this remains an opportunity. And then we have the redirectioning of capital flows. There have been some capital outflows from China, but we do not know whether other emerging countries, including Latin America, are now receiving more capital inflows this year. We have observed, however, that Latin America, in terms of portfolio investment, has increased its share in capital inflows to 20 to 25%, by contrast with a fall reported in prior years. As Pablo mentioned, our data show more or less the same. However, we're still far away from prior levels, like there was reported in 2009 or 2010, when Latin America represented more than 30% of capital inflows in emerging economies. So I believe that we could still see some positive outcomes. As for commodities prices, they have made it possible for current accounts to remain below 1% over GDP in the region. This year and next year, we expect a moderate deficit compared to a 3% average, as reported a long time ago, with growth levels remaining solid. And the fourth factor has to do with international interest rates. As Carlos mentioned during the introduction, we witnessed some developments this year due to volatility and also carry trade and some interest rate issues in the United States. We expected this to happen because usually that's what it happens when the Fed increases interest rates, but this has not affected capital flows. And this has happened with both residents and non-residents. As for domestic rates, we believe that they will remain on a downward trajectory, but the context is different compared to the one expected a few months ago. And then we have the idiosyncratic factors that have also hit the investment sector this year. There has been an increase in fiscal risk at the IIF. We have prepared some documents on what is happening in different countries. Right now, we're focusing on Colombia. We're also preparing some work about Mexico. We have also prepared a paper about Chile. This is therefore happening across the region but it has not been the case of Argentina, which is in a much more problematic situation, where the opposite actually occurs. We therefore observe that the risk premium will go up as a result of this factor. Which is our view of capital flows? Well, the snapshot is the following. In general, capital flows to the emerging economies have remained resilient over this year, and they are in line with the flows of the balance of payments that we have until the first part of next year. As for FDI has been growing. We expect a 4% growth over GDP, similar to the figure reported before the pandemic and similar to the figures in 2023, but still quite below the levels reported in 2010 and 2014, 30% less. As for foreign direct investment in countries such as Chile and Mexico, this has been quite positive over the year, particularly in Brazil. In Mexico, we observe that most FDI flows represent profit reinvestment rather than new investments. Mexico is sort of lagging behind. If Mexico received the average of the rest of the country compared to the size of, taking into account the size of its economy, should be receiving 30 to 40 billion or 60 to 70 billion per year. Regarding portfolio flows, capital inflows have rallied a little bit in Brazil. They did so last year. This year, we see some outflows in the share among shareholders. In Latin America, however, we see some portfolio investments from shareholders. As for the debt market, players have remained quite active. Therefore, we believe that this year flows will remain or will be in a positive turf. Investments have also been in line with what Pablo mentioned. That is to say, the trajectory has also been quite positive. In summarizing, taking into account the U.S. monetary policy and inflation performance, I believe that all this will give an opportunity to Latin American countries going forward. And we might expect a moderate impact. We will still have some tensions as a result of fiscal pressure in the United States and the possibility of heightened protectionism or heightened trade barriers, which could somehow counterweigh the positive impact that this could have in terms of capital flows to the Latin American region. All the same, we expect many opportunities along the way. And the countries that take quicker action in sending signs of a good economic policy to lure investments will be particularly benefited, but we do not yet see such signs being cast by any country in the region. The fact that some factors are moderating tailwinds next year will avoid any complacency and will lead countries to keep up with their fiscal efforts so that they can continue growing or so that they can grow more, because a 2% growth rate for the region, taking into account the social needs that the region has, is still too low. So policymakers will have a significant role to play in this moderately optimistic scenario for 2025. So let me stop here so that we have time for questions. Thank you very much. Thank you very much, Martin and Maria Paola, for sharing with us the key elements that you have highlighted and the figures that you have prepared in terms of foreign financing to the region and other emerging economies. It's quite clear that the region has certain characteristics that make it quite an attractive target for investments due to its wealth of natural resources and a growing middle class, as well as the fact that investors might expect more returns. However, capital flows are below the numbers reported prior to the pandemic, posing many challenges. Some of this is due to external factors and others due to domestic factors. It's very important to keep a credible monetary and fiscal policy and adopting growth-related measures. Inflation is also another important aspect. It has slowed down, but it still lingers, and that's why many central banks have decided to put their monetary policies on hold, and some of them might be thinking about tightening their policies further going forward. Okay, now we're going to open the Q&A session. These questions have been organized during the registration process. We have made a significant effort to organize these questions because we have received plenty. So we are going to raise these questions to each of our speakers today. Let me start with Pablo. So here's a question for you, Pablo. This is a question about the medium term with regard to capital flows. During the GFC, as well as during the pandemic, there have been some sign stops in the region that did not last much, especially in 2020, and we didn't have any foreign liquidity issues, as it happened, for example, in the 90s, that we can recall well. So to which extent do you believe that this can be attributed to the fact that the United States was directly involved in this episodes or science top developments at a global level, and therefore the Fed playing a significant role to provide a large-scale response. Now, talking about the pandemic and post-pandemic period, do you think that the macroeconomic policy frameworks in the countries in the region explain or account for the fact that there have been lower tensions in developed markets, particularly taking into account the issues affecting small and medium-sized banks in the United States, as well as the banking system in Europe in 2023? Okay, no doubt, Carlos. Over the past years, we have not actually witnessed very dramatic events affecting the emerging economies, as it happened, for example, during the 90s. This is very good news on the one hand, but on the other hand, it should actually make us ponder on the fact that things may happen and we have to be ready. You mentioned a couple of important points. During the COVID-19 crisis, as well as during the GFC, I believe that the monetary policy response in advanced economies was critical, for example, in the United States. And this translated into increased liquidity across the globe. It is true that the reason why volatility was lower can be attributed to the response given by advanced countries. However, afterwards, I believe that they did not react as quickly. But I believe that these policy frameworks have improved significantly in emerging economies where they have been learning their lessons. And the fact of having more foreign liquidity is not being challenged today. And this has contributed to more stability. What challenges do we spot in the future? Well, we cannot believe that we are not going to have a sudden stop if we have a trust crisis in the emerging economies, because in that case, the advanced economies will not give a response in order to help emerging economies. Therefore, we have to think how the financial architecture can be reinforced at an international level. There is a group of economists, the Latin America Financial Matters Task Force, that is now working to prepare a new facility for the International Monetary Fund in order to supplement their work. This is a mechanism or a facility that will provide certain resources that can be used in order to stabilize an index in case of a systemic liquidity crunch at a global level. Today, the IMF has many facilities that are targeted to each country. I believe that institutions such as FLAR and the strengthening of the regional network are critical. And on the other hand, at a more global level, we face another challenge. And that is the role of international bodies with the new lenders, particularly China and the Arab countries that have now been playing a very significant role in order to finance emerging economies. I believe that we are being faced with a challenge that can be tackled at a moment that is characterized by an optimistic view concerning future capital flows, but the risk is always dormant. Okay, thank you very much, Pablo, for your clear answer. Now, let me hand over to Martin. From the market perspective, Martin, in your opinion, which are the main volatility reasons affecting capital flows to the region? You have given us an overview during your presentation, but more specifically, I'd like to know about this. And in connection to the prior question, we are talking about high interest rates that have not led to sudden stop developments or events. So in connection to this, how do you think that the market is factoring in the preparation of the regional economies in order to face potential sudden stop events? I don't know whether this is paradoxical or not, but this year we have observed intervention situation in many countries by central banks in the foreign exchange market. And we have spoken about this, especially as a result of the Fed decision to increase rate cuts. So the question is, which toolkit the central banks have in order to provide a monetary policy response. Up until this year, this had not happened. We, however, did see some volatility events. It's a little bit difficult to explain, but let me start with the foreign factors that I believe are determinant factors. This year, we have observed some additional aspects concerning geopolitics, the conflict in the Middle East, geofragmentation, the impact of the US elections campaign. All this has contributed to a process of inflation that led some central banks to put things on hold. Brazil might have to increase interest rates after putting the interest rate cutting process on hold. We also see more risks in terms of prices. So geopolitical risks have somehow led to an increased risk of currency depreciation, whether we are talking about restrictions to financing, sanctions, or commercial restraints. I believe that all this has led to increased volatility in capital flows. Against this backdrop, domestic aspects become increasingly more important, and we see some spillover effects on the domestic economies, such as, for example, constitutional reforms that are ongoing in the region. Now, the good news is that we haven't observed any sudden stops affecting capital flows, and this is no doubt something to be highlighted as a positive sign. With regard to the responsiveness of regional economies to this scenario, I believe that the region is well prepared, as Pablo pointed out before. There are some target inflation rates that seem to be quite useful. We have been to Brazil recently, and we spoke about this. This coincided with the appointment of the next governor of the Central Bank of Brazil. They are placing a lot of emphasis on the act that promotes the autonomy of the central bank. They have also made a lot of progress in terms of capital markets and in terms of liquidity buffers through more diversification and by lowering risks. I believe that this has all contributed to shielding the economy as a way to put an end to volatility in the markets. From a fiscal standpoint, I believe that some progress has been made, but there is still a long way to go. There are some rules that are not being analyzed, and investors believe that sometimes the rules are not clear enough, and as a result, well, they are still struggling to guarantee fiscal discipline. And I believe that guaranteeing growth is also another key factor. Thank you very much, Martin, for sharing your insights and for highlighting the heterogeneity in the region. We have another question for Paola. Paula, I would like to know, how do you perceive the appetite of international investors in the region compared to other regions? You have spoken about this during your presentation, but I would like some additional details on this matter in case you observe a clear-cut appetite. Which are the main factors that actually should be pointed out? Yes, in fact, when talking to investors, they always talk about the geopolitical situation. That's always a prevailing issue. Let me go back to what Martin said when he spoke about the advantages that the region right now has, because right now the region is geographically located far away from the areas of major conflict in the world. And also because the region has a wealth of natural resources, as well as many commodities. So in the current context of geopolitical tensions, we see some issues to access commodities by countries. Therefore, the region has an advantage because it provides such commodities, not only oil and coal, but also other elements that are critical to the energy transition. So that makes the region particularly appealing. As Martin and Pablo mentioned before, talking about the macroeconomic policy frameworks, they are much more robust compared to many years ago. However, there is always some concern about the fiscal policies. That is perhaps one of the main concerns that investors have, because after the pandemic, we have continued to see some expansionary fiscal policies in countries such as Colombia, or in other countries that are very strong in terms of fiscal policy, such as Peru, where they have also deviated themselves from their fiscal policy targets. When you have significant buffers, as it is the case of Peru, despite of the political turmoil, it's very important to point out the role to be played by institutions in the region. And in the case of Peru, this has been quite emblematic. Despite all the political and social turmoil in the country, the central bank has remained independent and has been able to deal with all the pressures that it were imposed on it, and has been able to reduce the inflation rate, and that right now has reported very favorable growth prospects for the years to come. We always give the example of Colombia as well. Very often local people tend to be more critical and pessimistic as to what's going on internally. However, Colombia is doing quite well. In the current scenario and after the change in fiscal targets, and depending on whether there will be any easing of policies which might send a negative sign to the markets, we should say that Congress is now trying to avoid any fiscal deficits by taking the necessary measures. There are two other concerns. One that has to do with the political scenario and the election context in the region. There's still a lot of uncertainty. And then there is also a risk in terms of social tension. And finally, the growth risk, despite the fact that the region has been able to rally and has been able to grow on a stable basis, there might be some reduction in growth expectations as a result of COVID-19. So there are still some questions pending as to what is going to happen with growth in the region. In other countries, such as India, where growth is being strong, we see many positive developments allowing the middle class to grow. And we also see some significant investment taking place by public and private stakeholders. So some Asian and Asian countries and India are also now benefiting themselves from FDI flows. Thank you very much for your answer, Maria Paola. Next, we're going to focus on the future picture. We're going to start out with Martin. Martin, as Pablo mentioned before, in 2022, knowing you were able to learn about the policy that was announced by the Fed. It was great. It should be like that all the time. Let me ask you the following question. Thinking about the immediate future, tomorrow the Fed will make an announcement and the market expects a reduction in the fiscal policy. And in this context, which implications could this have in terms of capital flows to emerging economies and developing countries, particularly in our region? And what risks and opportunities do you envisage should this rate cut finally materializes? I believe that emerging countries continue to rely heavily on any changes in the US monetary policy. Of course, now China is affecting trade flows, but actually we are particularly affected by the United States. The market is already factoring in an interest rate cut, which will have a positive effect. But this will depend on how they make the announcement. And it also depends on the information that we can elicit as to the scope of the downturn cycle, the duration, the timing, the scope, and all the information that we may obtain tomorrow will be critical because there are different views in the market about the potential effects. As for geopolitical risks, taking into account wars ongoing and the US elections, this has also led to some divergence in monetary policy in Europe and Japan. And I believe that this could somehow counterweight the positive effects that an interest rate cut in the United States could have on capital inflows into Latin America. But the opportunities are pretty evident. I think that this could somehow renew the thrust of investors to start investing in the region. I believe that everybody knows the pass-through channels, the cost of funding. This might also be a relief in terms of debt servicing costs. FDI might become more attractive. This might also affect commodities positively, and this may lead to an easing of monetary policy in the region. The market is also pricing this in. Even though the inflationary process has been quite complex and quite heterogeneous, I think that significant progress has been made, and central banks are committed to price stability in the region. They're highly committed to price stability. So we might expect some opportunities coming in. Brazil and Mexico might be a little bit more limited due to some domestic issues. There are two kinds of risks. Foreign risks on the one hand. In this case, we have to see whether the rate cut might eventually guarantee a soft landing of the US economy. As Pablo said, the risk of a hard landing or a more disruptive landing has sort of faded out. At IIF, we believe that there will be a moderate kind of landing by the United States in 2025. In the domestic arena, we had to see which the economic policy response is. If we see complacency and too much relaxation in the fiscal and monetary policies in some countries, investors will eventually penalize those countries by pulling off. The economies might also become more competitive in order to attract these flows and investments. And in that case, we might expect a growth scenario in the region for next year. Thank you very much, Martin. It's been very interesting. Thank you very much for a complete answer. Now let me turn to Maria Paula. We are running out of time, so let me go straight to the point, and then I will give the floor to Pablo. Maria Paula, the current global scenario is the most prone scenario to attract foreign liquidity compared to what happened in late 2022 when we organized the same webinar as this one? That's the first question. And taking into account that many of our audience members today come from dollarized economies or partially dollarized economies, how would you answer this question taking into account the specificity of each country? Well, right now we are in a completely different kind of context. The last time we had this discussion, the context of emerging economies was quite complex. We had experienced a turmoil situation in the financial markets. Then the Russia-Ukraine war, the lockdowns as a result of COVID-19. Many central banks were also increasing their interest rates. So the scenario at the time was one of a shock, with interest rates and inflation rates being through the roof, and with a lot of economic uncertainty. We didn't know whether we had to make currency changes to reduce inflation. So it was a time of a lot of uncertainty. As Pablo said at the beginning, right now, we are at a turning point with interest rates going down in the United States and with an economy that still stands on a solid base. Therefore, I believe that we are faced by lower challenges today. But we still have some geopolitical risks which are real there might be some shocks as a result of the US elections where many things might occur. There might be an increase in tariffs or heightened trade barriers as candidate Trump is proposing. So many significant implications could still play out, and that might entail another risk to be factored in. However, I believe that the impact of the relaxation or easing of the monetary policy should have a positive effect for emerging economies. As for dollarized economies, they have the risk of not having sufficient flexibility to handle their monetary policy. And now they are facing high interest rates due to the Fed's policy. Panama and Ecuador, however, have reported low inflation rates to date, and apparently that might continue into the future, reporting even some improvement in their economic performance despite of these tighter financial conditions, even though there is less flexibility. I think that these economies have shown some improvement. And there are also some other ongoing conversations with the IMF for further policy adjustments. So our view about frontier economies, many of which are dollarized, is relatively positive in terms of growth prospects and in terms of new opportunities. And the numbers are already showing this. For example, FDI figures in Costa Rica have been very positive lately due to some advantages that some key sectors have in order to supply global supply chains. Thank you very much, Maria Paola. In closing, I would like to ask Pablo something that he has already given us some heads up, but I'm sure that the audience wants me to ask this question. How do you assess the capacity of the regional financial safety system in order to prevent a sudden stop situation from happening? Well, I believe that it's wonderful to have institutions such as FLAR in place, providing that safety net, at least for some countries. In broad terms, the region is much better off today because there are better policies and more liquidity in place, and also because today we are much more aware of the relevance of international organizations and how to address these kind of situations. However, we must continue to enhance this regional liquidity net. I'm very optimistic with regard to the policy framework. I agree with Martin and Maria Paula in this regard. There are very interesting examples. Peru is an interesting example. Peru is a country that lived through a lot of political instability. However, its economic policy framework was not affected by such political instability, and that's something that one would not normally associate with a Latin American country. In Argentina, and just to mention Argentina once, we have a national administration that is winning the war or trying to impose the idea that we need fiscal balance. Today, there are many divergences between the national administration and the opposition, but everybody believes that keeping fiscal balance is important. In El Salvador, Bukele presented a budget that also sets out this zero fiscal deficit target. So I hope that this will all make us more aware of the importance of fiscal balance in a context in which central banks have made a steady progress. In Latin America, however, I'm a little bit worried about institutional deterioration. We have observed that in Mexico. Mexico is a highly exposed economy to the United States. As Maria Paula mentioned, they might impose tariffs that might affect the country. But there are certain things that are now being discussed that clash against the free trade principles that are applied between the US and Canada, for instance. In my opinion, geopolitical risk continues to be a key factor. In Ecuador, the same applies. We need to understand what is going to happen in the coming elections in the country. All these factors will certainly determine how vulnerable certain economies are. With regard to dollarization, very often we believe that a dollarized economy is tied to a fixed exchange rate. But I think that the dynamic here is different. I don't see that Ecuador or El Salvador are exposed to a high risk situation unless a very disruptive geopolitical development takes place in Ecuador. I don't think it's going to happen in El Salvador. So this safety net remains of the utmost importance because we can never actually foresee what is going to happen for sure. Okay, thank you very much, Pablo. I fully agree. Unfortunately, we have run out of time, so we have to close this webinar. Thank you very much, Maria Paula, Martin, and Pablo, for such excellent presentations and insights. You have enabled us to compare different perspectives as for foreign and domestic risks faced by the region, which are critical in order to discuss economic issues. And this is important, particularly for the technicians and economists that are part of our audience today. The region has gone through many changes as a result of the pandemic. Capital inflows and outflows have gone down over the past years, and we expect they will be on the uptake in the coming months, with some risks and opportunities, however, that might cause these capital flows to exceed the ones that we had prior to the pandemic. And this will depend not only on foreign factors, but also on domestic factors. Here we're talking about geopolitics, the result of the US elections, and also how global and domestic inflation performs, as well as interest rates in the region and around the globe, and the borrowing levels. So the macroeconomic monetary policy frameworks in many countries have enabled many countries in the region to be more resilient over the past years. However, we cannot afford any self-complacency. We have to keep on doing our homework to guarantee macroeconomic stability, especially in terms of fiscal policy. Always bearing in mind, as Pablo said, that geopolitical tensions may come from different sources, because there would not be a crisis should that not be the case. Before closing, I would like to extend my appreciation to each one of you on behalf of FLAR, because otherwise this, and to the whole team, thank you very much to the audience for joining us today, and we look forward to the next FLAR dialogue. Thank you very much. Thank you,
Luego.
Carlos.
Creo que ya salimos del aire.